Hey everyone, welcome to the KE Report, another daily editorial, this time focusing on the broad averages as well as touching technically on gold and the gold stocks in terms of the ETF GDX. We are chatting with Dana Lyons, fund manager and editor of the Lyons Share Pro website. I should note that Dana is extending a special sale that was just going on this week for all of you, our listeners, offering one free month on a monthly membership or 33% off on an annual membership. You can email us if you want more of those details and for us to put you in touch with Dana, or visit the Lyons Share Pro website, which I will link to in the show notes. Dana, let's talk U.S. equity markets because, look, the markets have been very choppy. A lot around politics and trade wars, and I know you don't follow that as closely. You really stick to the internal models that you have, but look, these markets have been mostly trading in a range. There was an all-time high hit at the tail end of January, but that sure didn't last long. And now it's just a whole lot of choppy action. We've heard from some of our other commentators that breadth has widened out. Tech has been lagging. Dana, what have you seen within these markets, really underneath the hood?
Yeah, thanks, Corey. So I think on a micro term basis, we've seen some of those days of late where it's kind of been a schizophrenic market, but you've seen some days where you get some negative tech news, whether it's the DeepSeek news or some poor earnings in tech land. You've seen tech get its legs taken out. But that's more of been like on a micro term basis or a short term basis. If you zoom out and look kind of on an intermediate term basis, you're really seeing tech, not all of tech. Semiconductors still lagging, but a lot of tech is back leading the way again. You've seen a lot of the popular ETFs hitting or at least testing or consolidating near all-time highs after, pulling back from the December highs. So I'm seeing large cap growth really regaining that mantle of relative strength that it had until it topped, last July, August, had that big sell-off. I've seen a nice recovery from that, and like I said, regaining that relative strength mantle from much of the rest of the market, which, you had the broadening out, you had the rotation out of tech, out of semiconductors and the Mag 7 back last summer and into really a broader array, a broader swath of sectors and market segments. And that continued really after the election, had some nice breakouts, but December hit and we saw, almost an immediate deterioration in breadth. Some of those, the broader markets, averages, small caps, mid caps kind of turn on a dime lower and have really been lagging since. We've seen an uptick in our models, which are heavily breadth reliant of late. So that is one hopeful light at the end of the tunnel, perhaps. But really, on an intermediate term basis, still seeing lower highs in those broader averages of small caps and the mid caps, the equal weights, even as the large cap growth ETFs and averages are back up, testing or hitting new highs. So if you filter out some of those specific counter trend days, we're really seeing a lot of the strength back in some of those large cap growth areas.
Well, Dana, we've had a couple of guests on that have pointed out that in the ETFs, the spider ETFs, that some of the tech one is not as strong as it was last year, but that other ETFs within it, like communications, which still has technology in it, but also a couple other ETF sectors, were starting to pick up more volume, getting more influx of new buyers. So that's just in the last couple of weeks, ever since the DeepSeek situation. So I know that you don't usually overlay that short of a time period on things because you're looking at medium-term trends, but is it possible that there is some breadth that's actually spreading back out in the marketplace now, post some of the exodus from, again, semiconductors and AI stocks?
Yeah, certainly within the tech or growth universe, like you mentioned, you're seeing certainly semiconductors hitting lower highs and really actually hitting lower lows now, even as you're seeing improvement in some of the other tech sectors, like you mentioned. XLK, the broad ETF that you mentioned, looks okay, but maybe not the leader right now, as you mentioned. But we're seeing a shift into some of the other areas in tech, whether it's some of the internet plays, cybersecurity, is continues to remain strong and hit new highs. Telecom, as you mentioned, we've been holding a technology dividend ETF that has recently broke out to new highs. So no shortage of decent looking subsectors within the technology space. So it's not all or nothing. It's not, just the Mag 7 anymore or NVIDIA. If you broaden your horizon a little bit, you can see there are really areas and subsectors of opportunities even within that tech and that large cap growth space.
So, Dana, would you say that investors right now are leaning more aggressive or defensive in this market?
I think it's a mixed bag. If you look long term, we're still at that's where our area of concern is certainly at its highest would be in the long term. We're seeing those long term background measures, as we call it, basically at the most excessive levels they've ever been at. But on a shorter term basis, you're seeing some of the short term surveys and some of the short term sentiment measures that have really backed off excessive levels that we saw really coming into December, I guess. At the same time, I know you've seen a lot of retail flows into the market and into some tech names on those big down days, which isn't necessarily something you want to see when you're looking for a bottom, but at the same time, you need to see money flows coming in order to sustain a bull market. So I would not be surprised to see some more short-term gyrations, some backing and filling, but I do think we're setting up for another push higher, another leg higher. I don't see those signs necessarily of a major top being in place, despite what I mentioned was those historically excessive background measures. Those aren't generally good timing signals, though. So I do think signs point to eventually another leg higher, and I would look towards some of the indicators that you mentioned, some short-term investor sentiment figures to get a little bit more bearish or panicky, kind of like we saw in December during that sell-off, and also a sign of a broadening out within this rally. Like to see some of those smaller mid-cap averages actually break out above what has been in most cases resistance around that 61 retracement of that post-December decline. We've not been able to get back above there in a lot of those broad averages. So I'd like to see those few things to get us really more very aggressive again back in this market ahead of another up move.
Well, Dana, when you look at the trend that a lot of investors have of more passive investing, there's a lot of people that are just in the broad indexes, and that's been the trend for a while. It seems like if there's still a potential for another up leg in the broader indexes, that's not a bad place to be. But we've also seen some people put up charts that the equal weighted indexes have actually outperformed so far in the year compared to some of the weighted indexes, which leads people to believe that maybe there's some opportunity in individual sectors. When you're talking to your subscribers, are you encouraging them to get into individual ETFs that maybe have that bigger relative strength, or are a lot of people still camped out in passive vehicles just tracking the broad indexes?
Yeah, well, we'll go to wherever the relative strength is as identified by our strength models. So when our models, as we've talked about over the last few years, our models are heavily weighted towards breadth and market internal type statistics. They're proprietary measurements of that, but a lot of it is a breadth component because we want to be really heavily postured in the direction of the overall market. So if the broad market, if most stocks are going down, we want to be defensive and vice versa. So we did see our risk model really correlates highly to a lot of the equal weight averages and those broad measures. So we did see really our model was quite strong, turned stronger quickly after that July, August downturn as the broad market, the rally did really broaden out quickly. And it maintained that bullish posture even into early December and then turned lower when the breadth deteriorated. So during those times when our model's positive, you're seeing the broad market moving higher relative to perhaps the S&P 500 or a narrow average like that. That's when we like to be in those equal weight averages. We'll be aggressive in something like the RSP, which is the equal weight S&P. Right now, we're still seeing that particular equal weight average lagging. We're seeing the S&P 500 back up near the highs, even as the RSP, or the equal weight version of it, is hitting lower highs. So right now, we're still seeing a lagging in that broad area of the market relative to, that cap weighted S&P. So like I mentioned before, I'd love to see a broadening out, emergence of those equal weight averages like the RSP in order to get a lot more aggressive in this market. We're still quite defensive, but we are seeing little rays of light here and there in some of our indicators that make up our models.
Very interesting. Thanks for that overview on the market there, Dana. I think that's a very level-headed approach to this market. It doesn't sound like you're so worried about huge downside, but also still, as you said, a little defensive. Let's talk precious metals, especially gold. Gold has been very strong to start this year. It really looks like that $3,000 mark is coming sooner rather than later. Gold's already up around 7 to 8% just this year. So that's a month and about a week of trading. I know you follow GLD. Look, what are you seeing in the gold price? Just how much higher could something like GLD go?
Yeah, I think we're at this juncture where we're just going to let the trend run and take and book some profits here and there at key extension levels. So on GLD, we did just take a little bit of profits around 265, which was an extension of that post, really the trading range that we saw after gold topped out in 2020 and basically went sideways for almost 4 years. That breakout that we saw early last year has hit another extension level around that 265 level. So did take a little bit off of our position, still maintaining a healthy position. If I'm looking at GLD, the next real substantial level on the chart, extension wise, that I'd see would be up closer like 320 to 330. So, I mean, that it would be, from a gold perspective, that's still a one healthy up move from here. I don't think it would be in a straight line unless something crazy happens, but that's markets. Sometimes they happen. So right now, certainly willing to let our profits, let the trend run and not get too cute with it and just continue to take a little bit off here and there as we hit some of those key extension levels. But as they say, trend is your friend, and we'll just continue to ride with that.
Well, Dana, as far as the strength of the metal, it's been a good trend. It's been a good friend. Not as much in the mining shares, although they are starting to catch up and have had a lot better 2025 than they did in Q4 of last year. How are you looking at either the gold or silver equities?
Yeah, gold and silver equity. The miners across the board really, they've had a good start to the year for sure, but also rallying to lower highs. So until we see really breakouts and sustainable breakouts, we'll probably not be super aggressive. We do have positions in GDX, GDXJ, SILJ, but just this week we've taken some profits in each of them as we've ran into, again, that 61 retracement from that move down, I think, from the peak in October until right around the turn of the year. So saw a nice healthy retracement, but we've booked some. We've learned throughout the years, especially when it involves the miners, and we're not hitting necessarily higher highs than if prices are still within the confines of a trading range. It's really smart to take some profits along the way and add some dry powder in case we do get another pullback, more favorable entry point, but certainly taking some profits actually today and yesterday in some of those miners' names.
So Dana, let's just take a little closer look on that GDX chart, really starting from March last year, because that's when the shift really happened. The GDX went very significantly up. Since March, it was higher highs, higher lows until October, and then we had a series of lower lows, lower highs for Q4. But then 2025, the calendar turned, and GDX is up almost 20% this year. But as you said, it hasn't gotten back to that high in October. When you see a chart like this, where clearly it performed very strongly for a decent period of time, had 3 months, not even a full 3 months of weakness, and has come ripping back in just over a month. What is that level that you would like to see in GDX that would then confirm that a whole other uptrend is in place? Also considering the fact that I guess you're trimming because on a daily chart, it is in overbought territory now. So again, what level do you need to see that says ride this momentum higher?
Yeah, really, you need to see above like that 45, 46 level. That was the top in 2020. I guess the top in October was closer to about 44 and change. So you got to see higher highs to really have evidence that the next up leg is going to or commence, or you have potential for that. It's interesting that scrolling back further to the top in 2011, that when we did top out in 2020, it was basically right at that 61 retracement around 46 from that decline that we saw from 2011 to the lows in 2015, 2016. So it was really quite the logical place to top out or at least pause. And it's been more than a pause. Obviously now it's been 5 years. So I would have to see, a breakout above those prior peaks, above that 45, 46 level to really have confidence. Doesn't mean you can't be long going into that, and we are long somewhat, but I guess our trading strategy, anytime we're within a trading range, we don't like to buy breakouts and sell breakdowns. We like to buy pullbacks and sell into up moves to resistance as long as we're in the trading range, because the definition of a range is you're confined. The upside and downside is restricted. So as long as we're in a trading range, we'd rather be buying on pullbacks to certain support levels and selling into areas that could be resistance.
Okay. Then on the downside, do we just need to look at where GDX bottomed in December around that 33 region?
I could be buying a little bit around 39 and then down near probably be around, let me do some quick math, probably closer to 37. I could buy some on the way down. 39, 38, certainly there's a gap to fill, and then closer to 37, there would be pretty much a confluence of decent support levels there. So I wouldn't have to wait, certainly, to those December lows. Certainly if we broke that 36.5, 37 level, then it would suggest we're probably going down to test those December lows. But right now, I'd say I could be, after taking some profits just in the last couple of days, certainly could be persuaded to buy a little bit and pullbacks down towards that 37 level.
Okay. Hey, Dana, great chatting with you. Thank you so much for providing a very level-headed look at these markets. Again, if you want to take advantage of that special that Dana is extending, send us an email or click that link in the show notes to visit the Lyons Share Pro website. Dana, we'll chat with you in another couple of weeks. I hope you have a great rest of your week.
Sounds great. Thanks a lot, guys.